When you see an auditor's report, it's supposed to make you feel confident about a company's finances. But here's the secret. That confidence isn't about finding every single mistake down to the last penny. Not at all. It's actually built on this really careful balancing act between two huge ideas: materiality and audit risk. So let's decode what those terms really mean.
Okay, so this sentence right here, this is basically the heart of every single audit report you'll ever see. It is the auditor's core promise to us. But you'll notice it's worded very, very carefully. Those two phrases, reasonable assurance and material misstatement, they aren't just fancy jargon. They are the two pillars that the entire audit world rests on. And look, these aren't just questions for a textbook. The answers to these questions dictate exactly what an auditor is looking for, how deep they're going to dig, and, ultimately how much trust we can actually place in those big, glossy financial reports. So let's get to the bottom of it.
First up, materiality. Let's be clear, auditors are not on a mission to find every misplaced cent. Their job is to find the errors that are big enough to actually matter, the ones that could really make a difference. So here's the official definition, but the key idea is actually really simple. It's all about the user, people like you and me. An error is considered material if knowing about it would have changed your mind about investing in a company or lending it money. It's the threshold where a simple mistake suddenly starts to have real-world consequences.
The absolute best way to get your head around this is to picture the auditor using a giant filter. They're trying to catch the big rocks. Those are the significant, game-changing errors, while letting all the sand, the tiny, insignificant mistakes just pass right through. An audit isn't a guarantee of perfection. It's a guarantee that the big rocks have been found.
So how do auditors decide how big the holes in this filter should be? Well, they don't just guess. They start with the numbers, using these well-established rules of thumb to make a first judgment call. And these are the practical starting points. An auditor will pick a key benchmark from the financial statements. A lot of the time it's pre-tax income because that's what investors are really focused on, and then they apply a percentage. So for a stable, profitable company, an error that's around 5 to 10% of its income might be their threshold. For other companies, they might use something more stable like total assets or sales. This gives them a real, concrete number to start working with.
But hold on. What happens if an error is numerically tiny, but its implication is just huge? Well, this is where the second dimension of materiality comes into play. It's not just about the size of the rock. It's about what the rock is made of.
So you've got these two sides of the same coin. The quantitative side is just asking, how big is the number? But the qualitative side asks the much more interesting question, so what? What does this number actually mean? A small error might seem insignificant, but its nature can make it critically important.
And this is where it all clicks. I mean, think about it. A misstatement of just $1 that turns a reported profit into a loss, that is absolutely material. Same goes for any amount, no matter how small, if it involves fraud or is trying to hide an illegal act. Suddenly, the context of the error becomes way more important than its dollar value.
Okay, so let's switch gears and go back to the second half of that key phrase from the beginning, reasonable assurance. This is basically the auditor admitting that their filter, no matter how well designed it is imperfect. Reasonable assurance is a high level of assurance, for sure, but it is not absolute. It means the auditor has done enough work to be very confident, but not 100% certain. There is always a small, lingering risk that a material misstatement somehow slips through the net. And this accepted level of uncertainty has a name: audit risk. It's the inverse of assurance. So if an auditor is aiming for 95% assurance, they are by definition accepting a 5% audit risk. It's that small, calculated chance that they could give the financial statements a clean bill of health when, in fact, a big error is still hiding in there somewhere. So how do these two big concepts, the materiality filter and the acceptable level of risk, actually come together in the real world? This is where the planning gets really clever. Auditors use this really smart tool called performance materiality. Let's say their main filter is set to catch any error over, $100,000. They know that several smaller errors, like 5 different $20,000 mistakes, could slip through and then add up to a material amount. So what do? They set a lower, tighter filter for their detailed testing. It's a built-in safety buffer. You can almost think of it like a funnel. At the wide top, you have overall materiality. That's the big number for the financial statements as a whole. But then, as the auditor plans their detailed work on individual accounts, they use the narrower performance materiality to shrink the risk that all the little stuff adds up to become a big problem.
And here it is. This is the aha moment. This one sentence connects everything we've been talking about. The auditor is making a precise, calculated trade-off. They're saying, okay, our materiality filter is set at 25,000, and we are willing to accept a 5% risk, an audit risk, that we might miss something bigger than that. It's a perfect balance. And this is the crucial point. This balance between materiality and risk is what makes a financial audit practical and affordable in the first place. Trying to find every single error would be basically impossible. So instead, auditors focus their energy on finding the errors that actually matter while accepting a tiny, controlled risk of being wrong.
So the next time you see an auditor's report, you'll know it's not some declaration of absolute perfection. It's a statement of reasonable assurance, and it's built on a carefully calculated balance of risk and materiality. And this leaves us with a pretty big question, doesn't it? In a world that runs on trust, how much uncertainty are we willing to live with for our economy to function? The answer, it turns out, lies in that very delicate balance.